Welcome back, everyone. And yeah, now so we continue with the second part. Remember, we said the first part, we are just discussing the key risk a bank faces. Now we dive deeper into the Basel Accord and the implications it has on capital requirements. Okay, so let me just paint this picture. Now, for a typical bank, this is how the balance sheet looks like, right? So on the left hand side, there are assets, which really speaks to the things that as a bank we own, right? The things that belong to the bank. Now, these things that belong to the bank, they are financed by liabilities and capital. So the liabilities are sort of the people we owe from a private perspective, right? So our customer deposits, the sort of loans we've taken on interbank, the borrowings we've made on interbank, and then there's funding also coming from our shareholders, which we call capital. Now, what this Basel framework requires banks to do is at every point in time have enough buffer, i.e., capital, to guard against losses that would arise from these assets that have been created. Right now, this capital we are talking about can be explained in two forms. So we have what the shareholders have provided, right, in their books, which we call the economic capital, and we have what regulators also require, which is the regulatory capital. What we mean here, so let's say, for instance, in Ghana, the Bank of Ghana requires banks to keep a minimum of 400 million cedis. Now, this is what we call the regulatory capital. But you look at some banks and they have a billion, they have 2 billion, right? And that is their economic capital. So always the ideal situation is for the economic capital to be more than the regulatory capital. Now, all of these frameworks were established by, I call it the Central Bank for Central Banks, which is the Bank of International Settlement. Now, this institution established these guidelines that will serve as the minimum risk capital, which is the regulatory capital, which every bank must hold. Right now, these regulatory risk capital can be captured under the framework we call the Basel III framework. It means that we've gone through Basel I, we've gone through Basel II, and currently we are on Basel III. Right. Now, this Basel III is premised on three pillars. The first pillar is for the framework to provide a system of minimum capital requirement. Now, the second one will be the second pillar covers both the supervisory, so it covers both the supervisory role of the central bank in this case in monitoring that the bank is indeed adhering to this framework, and again also the bank's own internal review process. So not just the regulator, but as a bank, also from bottom up or from within, you should also ensure that you are adhering to these frameworks. The third one will be market discipline, because look, if the regulations are there and there's no discipline, then it becomes a fruitless battle. So there's also the need for market discipline, which is to encourage high standards of disclosure. Disclosures are very important. Okay, now let's circle back to the first pillar. First pillar, which has to do with the minimum capital requirement. Now, for a bank, we say your risk asset ratio, which is the same as your minimum regulatory capital, should be a function of your regulatory capital, right, expressed as a percentage of the risk in the various assets you have created. So if we want to see your risk asset ratio, how risky your assets are, we just pick your regulatory capital, which is your shareholder equity, and then we weight it by the risk in the various assets. Now, the risk in the various assets are put under credit, market, and operational risk, like we saw above. Right. Now, this ratio we are talking about, we say per the Basel Framework, is supposed to be at least 8%. Supposed to be at least 8%. So now let's pick each of these components and then walk through them. In terms of regulatory capital, yes, we are saying the least should be 8%, right? And this regulatory capital encompasses your equity, which is the shareholder, the stock, right? Some people call it equity shares or stock. Any reserves plus other long-term funding that has been provided, right? Now, this regulatory capital can be further segregated into two, where there's a tier 1 and tier 2. Now, the tier 1 we call the going concern capital. This is made up of your common equity tier 1, right? And then some shares, or the common equity tier 1 includes shares, stock surplus, retained earnings, some disclosed reserves, and then we net it off some goodwill. Now, this common equity tier 1 should be at least 4.5, right? So have a minimum of 4.5 out of the entire 6 you can get from tier 1. So if 6% for the entire tier 1, 4.5 should come from common equity tier 1, and then the 1.5 difference will come from additional tier 1. Now, apart from this standard tier 1, there could also be some buffers, right, which they are not mandatory, but you can just keep them for a rainy day. And these two are the capital conservation buffer and then the counter-cyclical buffer as well, of which should be up to 2.5% respectively. So having exhausted the 6% here, we are left with 2, which should come from the tier 2, and the tier 2 is also called the gone concern capital, which has to do with the subordinated debt, which is longer than 5 years, and then some general loan provisions. Okay, so now we have handled this numerator. Let's look at the denominator as well, where we are looking at the risk-weighted asset. Now, here what we have to do is, in all the assets, we have to quantify the extent of market risk, credit risk, and operational risk in those assets, right? So we start off with market risk. How do we quantify market risk? Now, there are two approaches. The first is the standardized approach, where Bank of Ghana will give you a template and then you populate a standardized, or you can use your internal models as well. The framework allows you to use your internal models subject to some conditions. And the conditions are that it has to be approved by the central bank, in this case, Bank of Ghana. And for those using value at risk model, it is quite specific. The holding period should be 10 days. The confidence level should be 99. And the look back or the observation period should be at least 1 year. So if you fulfill all of these, then BOG is going to give you a green light and you can proceed to use your internal models. But if not, then you have to use the standardized model that the central bank requires. Now, the next one we'll look at will be how to quantify credit risk. Again, the approaches here are two, where there is a standardized method, right? So there's a standardized method and current exposure method as one. And under this method, it is you simply saying the credit risk here is the risk weight of the counterparty. So each counterparty would have a risk weight, and then you multiply by obviously the type of transaction. Because if you are just selling dollars to somebody, the exposure is different from giving a mortgage. So it will be the risk weight of the counterparty and then multiplied by the factor for the transaction type. Just like the market risk, if you don't want to use a standardized, you can also use your internal approach, right? Where again, you go through your internal models to sort of quantify this credit risk, right? Now, this model requires the following inputs. So it requires you to know the probability of default, the exposure at default, the loss given default, and then the effective residual maturity, or the tenor or the time to maturity of the exposure. So when you put this into mathematics or a mathematical formula, we are saying your expected credit loss is a function of the probability of default, the loss given default, and loss given default is computed as 1 minus recovery rate, and then also the exposure at default and the time to maturity. Now, how do we control credit risk? We mentioned this earlier, so we're not going to waste too much time here, and then move straight to the risk weights for operational risk. Now, for operational risk, mind you, there are 3 approaches. So the first 2, for market and credit risk, there are 2 approaches, but for this there are 3 approaches. And the first one will be the basic indicator approach, which currently is no longer in use, but it is just simply saying your operational risk is 15% times the average income you've made, the average gross annual income you've made over the last 3 years. Pretty simple. Then there's a standardized approach where here you dissect the bank into various units, various departments. Then for each unit, you do the same 3 years annual gross income, right? And then you multiply this for each segment by a risk factor, which is between 12 to 18. The last one will be the advanced measurement approach. Here we are saying the bank uses internal models, but these internal models should fulfill these conditions, right? It should include potential severe tail losses. It should take a 1-year view and incorporate a 99.9 confidence level. It should cover both expected and unexpected losses. It should take account of internal, external data, scenario analysis, etc. It should also be based on a loss database with history of at least 3 years. Okay, so we conclude with something very important to capital we call XVAs, or value adjustment. Now, these value adjustments could be done for funding, could be done for capital, could be done for market risk, could be done for credit. But this discussion will only focus on credit value adjustment. Remember, yes, in the trading book, you are doing mark to market, you are marking your books and all of that. But these mark to markets don't incorporate to a greater extent the credit loss in there. So what some banks do is, in addition to this mark to market, they find something we call the credit value adjustment, right? And Basel requires this CVA charge for OTC derivatives. So if you are trading OTC derivatives that are settled bilaterally, you need the CVA. But for those that are settled via an exchange, you wouldn't need the CVA, right? So that will be the conclusion for the first pillar under the Basel framework.